Okay, everybody, let's get started. Good afternoon and welcome back. Hope you're all well, healthy, happy, safe. Uh, we want to get started so we can get you home. Well, I guess you're already home, so scratch that. Welcome back for those who've been before, and welcome for those who have not been here before. Today, we're going to talk about a couple things. We'll give a brief market update, but we'll also talk about our investment policy committee meeting where we kind of dig into the nuts and bolts of what we're thinking and what we're doing. Hopefully, it won't be too technical. We'll try not to be technical, but give you some good information. As usual, I'm joined by Sharon Head today, who is at the world headquarters in Augusta, Georgia of AP Wealth Management, as well as Millie Robinson. Sharon will run through how to ask questions, and Millie will be pinch hitting to help with any technical issues should you need them during the course of our Zoom here. And I'll remind you, please ask questions either during the briefing or at the conclusion. That's what this is really all about. So Sharon, I'm going to turn it over to you.
Okay, thank you, Gene. Yes, so I think everyone pretty much knows, but if you will just use your chat box, which is in your toolbar, and send a question to either me or to everyone. You can do it either way, and we will take those. And if you would like for your mic to be unmuted so you can speak, just let me know that, and I'll be glad to do that too. All right, thank you, Gene.
Thank you, Sharon. All right, let's get started here. So, been kind of a crazy week since we got together last week, but on the whole, pretty good. Monday earnings started coming out from companies, and yesterday earnings were not great. There's no surprise there, but the market actually reacted favorably to poor earnings report. We don't look at the market every day. We've talked about that before, but a little brief today is more earnings came out and the market reacted somewhat negatively, but it seems to be finding its level. Just as a reminder, we're still holding meetings with clients and future clients. We can either do it via Zoom or do it via phone, whichever is most convenient. We do like to do it via Zoom because, as you see, we can pull up statements and graphs and so forth that we can talk about. As we continue with the market, I'll reiterate that from our perspective, we're not done with the volatility, nor are we back where we think we might be. I don't think that anybody knows that. But we're comfortable erring on the side of missing a little bit of the upturn rather than jumping in too early. So that'll be a little bit of a theme as we talk through our investment policy committee meeting today. So let's talk about the meeting we had last Monday, and I'll give you a little background. The investment policy committee meeting is typically we get together once a month and we talk about all the positions we have. We talk about whether they're doing what they're supposed to do. We talk about new opportunities or things that we see might be of value to us. We talk about what's on your screen today, which you've seen many times before, and that's asset allocation at the top. And on the left, we talk about time horizon and our crafted to last portfolios. And we talk about security selection and remind ourselves that that does not create value in the long run. But it's also only part of our process. When we look at what we're doing every week, we also look at our core positions. We look at how they've done year to date, how they've done versus the indices. And then we also take some portfolios and look at those from a return standpoint, from a profile standpoint. Is their asset allocation correct? So today we're going to focus on our investment policy committee meeting, which was quite interesting on Monday. And I'll take you to this slide that you recognize from before, and I'm going to use my laser pointer here we're going to review a little bit of this as well, our 4 portfolio groups: attain, relative return, opportunistic, and protect. So as we move forward, the investment policy committee meeting, I talked about what it is. And for purposes of our discussion today, we have five profiles, 1 through 5, 1 being our most conservative, 5 being our most aggressive. So as we talk about discussions in our investment policy committee meeting, we focus primarily on the midpoint, which is profile 3, and that's what's up on your screen right now. So profile 3 has a 50 to 70% equity exposure. It can be as high as 70%, should not be higher than 70%, can be as low as 50% in stocks or equities. Right now, we're right at the midpoint. Our profile 3 is at a 60% equity exposure based on valuations currently. So one of the things that came up in our investment policy committee meeting was how much exposure do we want to Asia? And really, when we talk about Asia, we're talking about China. There are certainly other countries, Malaysia, Thailand, Vietnam, but China is the dog that wags the tail of Asia. And after thinking about it for a very long time, we decided to decrease our exposure in Asia. And the way we're going to do that is Matthew's Asia Dividend Fund, which is a great fund, but has primary concentration in China. But even though the concentration is not completely in China, all of the other countries that are in the Matthew's Asia Dividend Fund are heavily affected by China. So we decided that we were going to remove that fund. We're not going to do it all at one time. We'll still have international exposure because we think it's important, but we'll have more broad international exposure in Europe, which we've always had, and we'll continue to have broad exposure, but we'll continue to have exposure in Asia as well. But based on what's happened in China, we decided currently that we would reduce our exposure to Asia. One of the reasons that we did that was we favor the US equity market over international markets right now. So one of the things we talk about is, should we get rid of international exposure? And the answer clearly is no, because we don't know what's going to happen. So we've got exposure internationally, not just in the US, although we favor it. And a great example of that is we would never have thought interest rates would go to as low as they are at 6.6% now, almost 0.7%. We just don't know what's going to happen. Typically, there'll be waves where international outperforms domestic or US equities, but we just don't know. So we will keep exposure to international equities, but reduce ours in China. Then, as I referenced in our 4 portfolio groups, one of them is Attain. And just as a reminder, Attain is where we buy into the markets at a very cheap price. And if the markets go up or the markets go down, we typically use index funds and exchange traded funds to do that because they're very inexpensive. We will use those vehicles. And how do we best get that exposure? Well, if we like the US best, one of the things that we've used typically, and we talked about this, is the Schwab US Broad Market Exchange Traded Fund. And an exchange traded fund is very much like an index fund, except it trades like a stock. That's the simplistic name for it. So we also like, and those of you who are clients know, we use the Vanguard Growth Exchange Traded Fund. So we had a long discussion about the 2 of those. What's very interesting about that, growth, just as a reminder, are companies that are doing well and continue to do better, as opposed to value are companies that are beat down and we think will improve, or the market thinks they will improve. So growth has been on a tear recently, but this Vanguard Growth ETF fund has outperformed the US Schwab Broad Market ETF. And the reason why we keep it is because the Schwab Broad Market ETF has small cap and mid cap exposure. And just like we want to keep international exposure, some international exposure in our portfolios, we also want to keep small cap and mid cap. So let me pause there and explain and talk briefly about small caps and mid caps, because I can go off on a tangent here at times. But small caps would be very small companies that are smallly capitalized, i.e. they don't have necessarily big or strong balance sheets. They typically don't pay a dividend. They're companies that you probably never heard of. We don't have a large allocation to small cap companies, but we do want some allocation to small cap companies because they can perform. They're going to be much more volatile. Moving up the food chain to mid cap companies, they're just what they say. They're slightly bigger or slightly more capitalized, have stronger balance sheets, have more assets. They typically don't pay a dividend either, but they're going to have been around a little bit longer, perhaps. They will be bigger. Typically, not a whole lot of names you're going to have heard of either. And then at the top of the food chain would be large cap companies, or companies that have a large capitalization. They're typically going to pay a dividend. They're going to be companies that you've heard of: Microsoft, Johnson & Johnson, ExxonMobil. They're going to be heavily capitalized companies. So going back to the US broad market ETF, and we juxtapose them against the Vanguard Growth ETF, by using the Schwab Market Broad ETF, even though it hasn't performed quite as well as the Vanguard Growth ETF, it gives us broader exposure, and that's why we decided to keep it. So as I mentioned, our profile 3 is at a midpoint right now. It can be as low as 50, as high as 70. It's currently at 60. The other thing we look at is we look at the underlying expenses of our holdings. So right now, our profile 3 has what's called a 0.3 expense ratio. So 0.3%, it's very cheap. And so the underlying cost of holding the investments we have is a 0.3%. Very, very, very competitive. Not something that you as clients or you as future clients need to pay attention to, but something that I want you to know that we look at. Okay, as we talked about attain, and we talked briefly last week about opportunistic. Opportunistic is where we're looking for value, where we might be looking for investments that have been beat down or have lost value. There's a lot of them right now, but that can be up to 20% of a portfolio, typically 20% of a profile 3 portfolio on the equity side. So what we looked at and what we discussed in the investment policy committee meeting was real estate investment trusts, energy, S&P 500, consumer cyclicals, and financials. All of those have been beat down very much, particularly energy, financials, the banks, and so forth. Consumer cyclicals would be consumer-oriented companies. They've all been beat down. It's our feeling that it's too early to move into these areas yet. We don't think the volatility is done yet, and we think we need to give time to most of these investments to figure out what's going to happen. As I'll talk about in a second, earnings season is going to be very important as we move forward, and it'll tell us a lot. The one exception is we're starting to move into some REITs. REITs have typically a nice yield being what does it pay out in cash, like a dividend for a stock. And REITs right now, the ones we're looking at, can be 5 to 8% in yield for money that they pay out based on the value of the investment. And a REIT is a real estate investment trust. They have some certain parameters they have to live their lives by and guide the companies by, but we think those are worth looking at now, so you're apt to see us begin to buy some REITs. But we're going to hold off on some of the others that you're seeing there on screen. And as we think about opportunistic, we had a great discussion about what is opportunistic. And so opportunistic are those investments that we think will recover faster than the market. And let's say the market's the S&P 500 or the Dow Jones Industrial Average right now. An opportunistic investment for us would be one that when we looked at it, is it going to recover? We don't know how long the S&P 500 or the Dow is going to take to recover, but will it recover faster? Those are the investments that we'll entertain in our opportunistic space. The other thing I want to tell you about opportunistic, and that we talked about briefly in our investment policy committee meeting, was if we're not willing to keep an investment 6 months in our opportunistic portfolio, it's probably not worth us buying. So 6 months is typically how long we're going to focus on a minimum on keeping an opportunistic investment. Okay, fixed income, also known as protect in our four core groups. Fixed income would be bonds, typically, sometimes CDs. But when we look to bonds, there's two ways you can look at bonds. You can look at what's the yield or the return on the bond, and the higher the return on the bond, likely the more risk you're taking. So there's more risk in a higher yielding bond, i.e. that's where junk bonds, the term junk bonds come from. Right now, we value quality over return. So we don't know what's happening in some of these companies underneath some of these bond covenants or in these balance sheets. So right now, we're willing to accept a lower return on bonds for a real stable investment, one that's not going to go belly up. A couple of other things that we're doing that do relate to the investment policy committee meetings. One of the strategies we mentioned a while back was using tax loss harvesting to take advantage of some of these downturns. Now, this would be for taxable accounts, not for retirement accounts. So in a retirement account, when you buy or sell something, you pay no income tax on that gain or loss. In a taxable account, you will generate gains or losses. So the idea behind a tax loss harvest is you sell something at a loss. There's a lot of opportunity there. And then you go buy a similar investment. It can't be the exact same investment, but you go buy a similar investment and you're able to book a loss and help you on your income taxes. We're also moving towards our models. Since we got rid of Matthew's Asia Dividend Fund, we've slimmed down some of the models and we've begun to move towards our model. I talked about rebalancing as one of our strategies as well. And so by moving to our models, we're beginning to rebalance. And just as a reminder, what rebalancing is, we have a target asset allocation for each client, and for each client, it's typically different. But as we have a decrease in the value of equities, we want to go buy equities to get them back up to the predetermined percentage of their portfolio, which means we'll go buy equities when they've gone down in value and typically sell other investments that have possibly gone up in value or stayed the same in relation to everything else. So those of you who are clients that are on the Zoom briefing right now, you will begin now to see some activity. We're not doing anything really heavy right now, but we're beginning to rebalance in tax loss harvest. So you'll see a couple things, and you'll probably see some REIT purchases as well. And the last thing that I'll repeat on there again is earnings season. Earnings season kicked off Monday, so 3 days ago now. And what we're going to find out is how well did the market bake in the bad news that's coming. As I mentioned, I think on last week's Zoom briefing, they baked it in probably a little too severely 2.5 weeks ago or 2 weeks ago when the Dow was down at 18.2. We found some level here. Again, this may not be our level. We think there's probably more volatility coming, but we're going to find out. Some have surprised. One of the ones I looked at today was Netflix. All of those who are sitting home watching TV or binging on Netflix, there's a lot of folks who haven't subscribed, believe it or not, so their subscription numbers are up. Amazon's doing very well. So there are some that are fighting the tide. There are others that, as you can imagine, some of the financials that are doing very poorly. So I hope I didn't get too technical, and I hope that gives you some insight into what we talk about in our investment policy committee meeting. There's much more that we do, but it's incredibly valuable for us because we all get to exchange ideas with each other. We're usually congruent on it, but sometimes we have to vote on things we need to do. But we also get on the same page. And if we're reading from the same prayer book, that's typically good for our clients and good for us. So now I'm going to open it up for your questions and discussion. And the lovely Sharon Head will moderate us and help us with that.
We have a couple of questions, Gene, and
Okay.
The first one is, could you explain REITs in more detail? Not familiar with them.
Okay, happy to do that. REITs stand for Real Estate Investment Trust. And so a REIT will typically go buy or participate in the purchase of an apartment building, a medical building, part of a hospital, apartment complexes, and they'll put a portfolio together of these real estate holdings. So they could hold as few as 10, they could hold as many as 100. There's all sorts of REITs out there, real estate investment trusts. When you have a real estate investment trust, they get some tax benefits of being a real estate investment trust. We don't need to go into those today, but the trade-off for those is they must pay out 95% of their income in dividends or interest or capital gains distributions. So typically you're going to buy a REIT not for appreciation, although you can buy them for appreciation. You're typically going to buy them for investments, and particularly investment income. And when interest rates are really low, like they are now, people are seeking income because you can't get it from a bond because interest rates are so low on bonds. So typically REITs will outperform. This is a crazy market. They're beginning to recover, and that's why we're looking at them. But I hope that helps with REITs.
And then the next question is, are you projecting a V recovery, or wait and see?
It's a wait and see for us, everybody. And you're probably tired of me saying this. We're in uncharted territory where we've never been here before. We don't know what's going to happen. We're beginning to open up. I mean, people are talking about opening up cities and so forth. I don't know whether that's going to happen. My simplistic brain looks at it this way. We're a year away from everything I read from a vaccine. And until we have a vaccine, we're not going to be able to gather in large groups. I don't know if that's the case, but if that is the case, I don't see how we could have a V recovery. We may have a U recovery. I've been reading a couple of articles. There's a square root recovery where it goes like this. There's all sorts of recoveries, but I think a U recovery at best, but it may be a long underline on the U.
Okay. And
I've got
then we
one
have
on
a
my
question.
chat screen. Can
Yep.
I go? Okay.
Yes, please.
Fixed income treasuries yield at sub 1% seems to be equivalent to a PE ratio of 100 plus, albeit a relative risk free rate. Presuming all this crazy debt does not create a downgrade, do you think Tina will drive future stock valuations? So, very technical question and a very good question. Yes, low interest rates, I think that's what you're getting at. Will it drive stock valuations up? I hope that's what you mean. If it doesn't, send me another chat. But yes, when there's no place to go get yield, at some point, people are going to chase yield from dividends, typically in large cap stocks. And that should move the needle at some point. But again, we're in uncharted territory. That's an assumption, but I think at some point, yes, if interest rates remain low, it will drive resources into the equity market. I hope that helps. I've got one more on my screen.
You got another one? Okay.
As estimated tax payments due date is delayed until July 15th, any recommendation for use of the cash, pay the tax, invest, hold? For picking REITs with current risk, their tenants won't be able to pay during COVID-19. Is there a minimum quick ratio or other measure to guide the selection? Another very good question. Yes, when we look at REITs, we typically look at the portfolios, and I'll answer the two questions separately. We look at the portfolios and look at the lease up and the arrangements and sort of the high end or the folks that are renting them. So we'll pay attention to the type of tenants that are in there typically. And we try to stay away from REITs or REITs that hold a portfolio of what perhaps might be low end housing, which may have a difficult time paying rents. On the estimated tax payments, another good question, since they're not due till July 15th, that's such a short-term time period. You want to keep those in cash. You could buy energy or some other underperforming asset and hit a lick, but again, we don't know when it's going to come back. So my suggestion for money that's being held for taxes for July 15th ought to be just kept in cash. Sharon, those are the only ones I have, so take it away.
Okay. The next question is, and it starts off saying this may be too simplistic. It's not. But with the massive influx of cash, is the government just printing money, and will there be a massive inflation at some point?
A great question, and one that I've gotten a couple of times. Yes, at some point, there's going to be inflation. The problem with that is we've been saying that we're going to have inflation for the last 8 years, and we're going to have increased interest rates. We have to have it, but we haven't. So I think, and I think we addressed this previously, at least I did with someone, we've got to have demand outstrip supply for us to have inflation, or the inflation of prices. And right now, that's not a problem. With the infusion of cash, it seems like it would be a problem, but it hasn't been a problem for 8 or 9 years. Right now, I think, as I've related before, deflation is probably one of our biggest concerns. And to that end, we mentioned energy. Energy is now at $20 a barrel. It could go lower, where we're looking at gas prices that are what we used to see when we were children almost. So inflation adjusted, those are crazy numbers. And it's not so much what's happening, if y'all are following energy, the spat between Russia and Saudi Arabia, which has been not completely cured, but it's been addressed. But it's that planes aren't flying, cars aren't driving, people aren't going anywhere. There's no demand for energy and oil right now. So I hope I answered your question about inflation. And the reason I referred to energy is typically energy is something that's going to drive inflation, inflated prices.
I don't have any other questions, so I don't know if anyone else.
Well, as a reminder, there's no such thing as a dumb question. So please ask your questions. And we also have on our call, I think, don't we, Sharon, Tom O'Gorman, who sat in our investment committee meeting on Monday. And Sharon, you can unmute Tom if he's got any other things that I've left out, which I'm sure I have.
Okay, Tom, I have unmuted you.
Hello, everybody. Can you hear me okay?
We hear you great.
No, Gene, you've done a great job. I think you covered our meeting really well. And I think, everything I'm reading is there's still so many unanswered questions. We're hitting so many different historical news, not only with the pandemic, but the level of employment. We'll see another 5 million people probably have applied for unemployment tomorrow morning. That will probably end up somewhere around 40 million people unemployed, hopefully for a very short term. We have unprecedented government intervention here. And the inflation question was a great one, because I am an economics major from school, and when we were taught that when these kinds of things happen, it all led to inflation. But I think Gene stated it pretty well. Right now, the demand is so low, it's going to take a while before we see inflation. And then, of course, the energy situation is going to mute that as well. So just some really interesting times, but I think Gene's covered it well. We're taking this very carefully. Very conservatively. I think you'd agree that probably everybody's most comfortable with U.S. stocks and large cap U.S. stocks at the moment, and that's where we're focused, to minimize our clients' risk and get everybody the best returns we can during this difficult period.
Well said, Tom. And there's an expression for where we are, and that's catching falling knives. We don't want to be catching falling knives as maybe we hop into the market too quickly.
Okay. And I have another question, a couple more questions. Says, looking at my statement, what is the difference between the Schwab Premier Bank and Charles Schwab Bank? Would you like me to?
Sharon, I would love if you would take that question.
I believe, and I can let you know for sure, but I believe it was just a name change at the beginning of the year. I don't think there's really anything significantly different about the two banks. I think they just had a name change was all, but I'll let you know more tomorrow. Okay, and then our next question is, good call on holding cash, even considering the guy with the Clemson degree. Is there an internal threshold where we will start buying equity, particularly value stocks? The yields look attractive at below 20,000 or 20. I think that's, yeah, 20,000, 20% maybe. I don't know. I'm not sure. So.
Yes, the earnings season, as I reflected earlier, will give us some clues about, there's not going to be an all clear sign. I mean, there's just not an all clear sign there where we're going to go, okay, the PEs have hit a certain level. That's the price earnings ratio, which we've mentioned before, or the Dow's at a certain level. It's going to be different valuations for different areas, but absolutely there are some things on sale, and we're already beginning, as I referenced, rebalancing and moving towards our models to making some purchases, including buying REITs. So yes, there's going to be some purchasing, more rebalancing by filling out. As an example, our profile 3 is at 60% right now. We can go as low as 50 on stocks and as high as 70 on stocks. At some point, if we see true value, we will move up to closer to 70% in stocks. I hope that answers your good question.
I think so, because I just got another message back about the S&P level of 20,000, thinking TINA.
The PE on the S&P 500?
S&P level of 20,000.
Okay.
Yeah. So, and you probably see, I think everyone sees Anne Marie's comments here. So, I guess stimulus checks are arriving.
Good.
Yeah.
And while we're doing that, one of the things we talked about discussing next week, in addition to a brief market update and answering your questions, is addressing the Stimulus Act and the CARES Act, how it may affect taxes, and perhaps how it may affect you. So if that's something that you have some interest in, please let us know. Or if there are other topics, please let us know as well. Tom, anything you want to add before we wrap up?
No, I just ask everybody to be patient. I mean, I think one of the great things we bring is between Gene and Pat and myself and Clayton, we do have 80 years of experience, and we're putting that all to good use right now. And we appreciate your patience and trust in us. And I can assure you we are on top of this thing as best as we can be.
Terrific. Thanks. Sharon, anybody else out there?
I don't see anything.
Okay. Well, like they say at the bar, this is last call for questions. And I'll sign off by telling you, thank you for your business. Thank you for joining us today. Thank you for the confidence that you placed in us. It is very much appreciated. It's not taken for granted. But I also want to reiterate what a great team we have, in addition to who Tom mentioned, Sharon, who's helping us today at World Headquarters of AP Wealth Management. Millie's also on the call. They do a fabulous job. And Maddie up front, we're very lucky to have them, and we're grateful to have them. We're grateful to have you. Again, please send us your comments. Please send us your suggestions. Stay safe, stay apart, and stay smart. And call somebody that you haven't talked to in a while and let them know you're thinking of them. All right, everybody. Thank you for your attendance today. Be good.